tell us exactly what's the purpose of this video.
uh, Getting to know the risk appetite and whether capital wants safety or risk in the end.
It kind of is your bicycle.
This might be one of the single most important variables for Bitcoin from my perspective.
While do the math, price go up.
Hello everyone and welcome back to the Diligence Editions podcast. And first of all, Happy New Year's to all of you. My name is Philip and today we've finally got the full crew assembled back together. Once again joined by my two co-founders, Leo and Ayush. How are you guys doing?
Doing good. Had some time with the family, I guess. Spent the whole year in the trenches, I would say. So it's good to think about what happened last year, especially with crypto, but also look ahead. Think about what's important, what's not important, also on a personal level. And looking forward to a really good year with you guys. So
Yeah, myself had a good New Year's Eve as well. And let's say we got a much needed break going into the end of the year. But yeah, I'm very excited for this particular video that Philip, took the lead on. And Philip, yeah, why don't you go ahead and tell us exactly what's the purpose of this video?
Yeah, absolutely. As I've been mentioning today, we are doing something a bit different than we normally do. Today we are not only covering a single event, or maybe as we did last time with the Japan carry trade. We're not breaking down one specific country or the situation it is in. Today we are more so giving you like an actual framework that we personally also use to scan through the macro landscape. And as I've been mentioning today, we'll be speaking about the 10 most important macro indicators that actually matter for digital assets and also like the overall crypto space. And just a little heads up, this episode will also serve as a little explainer towards those indicators and events. But we can already give you like a little hint. We will be doing a special episode in probably like 2 or 3 episodes with one of the guys who is probably one of the best in the space when it comes to macro. We're speaking of Mark Connors. He's the founder and chief investment strategist at Risk Dimension, and he has an overall, I think, 30 plus years of experience in TradFi across markets, across risk management and investment strategy as well. He is also the former director of research at 3iQ, which is one of the biggest asset management firms in Canada. And yeah, as I've been saying, like this upcoming episode will be probably the perfect episode to stress test our ideas against someone who is actually like managed risk across multiple markets and also cycles. So yeah, as I've been mentioning, we will be breaking the 10 indicators down into 4 different layers, I'd say so. First off, we got the liquidity layer, which pretty much signals where money is flowing as of right now. Then second off, we got the policy path layer, which shows where the Fed is going to go before they tell you. The third is risk appetite, which is sort of showing you whether capital wants risk or more safety. And then we have the global regime layer, which is pretty much signaling if macro has some major shifts or if there's major shifts happening on that end. It's sort of like the framework we want to like go through as of right now.
Philip, yeah, good point. And look, you don't need to become a macroeconomist to use this, right? The whole idea behind these videos are not immediately an expectation that everyone will understand this. Is more an introduction. So yeah, let's get right into it, I would say. Let's start with the first layer, which is the real-time liquidity layer. Think of the liquidity layer as a set of indicators that mention what is going on right now instead of where are we heading, which could be all kinds of other layers. But the first layer is mentioning what is currently happening. And this layer has 3 components. You've got the Fed repo operations, the Treasury general accounts, and dollar swap lines. And I would say, let's just immediately start with the Fed repo operations. So the first indicator, which is the Fed repo operations, Think of the Fed repo operations as as an actual coin, I would say, with two sides, which is actually a mirror of, well, two people, I would say. The first is the first reverse repo facility, the RIP, and the second is called repo. Could be kind of confusing. So you first have the reverse repo facility, and on the other side, the repo. They sound similar, but they do not exactly do the same thing. And well, they do the exact opposite thing. And understanding both tells you everything about whether liquidity is abundant or stressed. So yeah, let's break down one at a time. So first, the reverse repo, which is essentially a parking lot for excess cash. Money market funds, banks, and other institutions can take their cash, give it to the Fed overnight, and get securities as collateral. And the next day, a trade reverses, respective of or related to that. So the key point is when institutions park money here, that cash is removed from the financial system. It's kind of, what's the correct word? It's sterilized. It's not being lent out. It's not chasing assets. It just sits there. So think about, with these two indicators, with the financial system as a bathtub. The reverse repo facility is like a drain plug. And well, when the RRP balance is high, like it was in 2022, trillions of dollars were sitting in that drain, not circulating and not bidding assets. And well, when the RRP drains, that money flows back into the bathtub. So draining is actually good. It re-enters the system and it has to go somewhere. And well, for example, stocks, T-bills, crypto, anything that offers a return. And here's the thing that blows people's minds quite a lot. Since late 2022, the RIP has drained like around 2.2 trillion, which is insane. And that 2.2 went from doing nothing to, well, actively flowing into markets, what I've said before, into equities, into crypto, into T-bills, etc. And this is one of the real reasons the markets rallied, despite the fact that the Fed hiked rates to 5% currently. And everyone is kind of still confused. How are stocks going up when costs are at the highest and when the Fed was hiking rates? And yeah, this is one of the things that caused massive liquidity injections in a backdoor manner. So in a manner that not a lot of people see, but which still occurs.
Yeah, thanks for that, Leo. And, just to elaborate on your point, yeah, now that the RRP has hit zero, essentially the tailwind into crypto has kind of disappeared, right? Because there's no more hidden liquidity left to drain. So in a way, the market has kind of lost its support system. And yeah, we think it's relevant for anyone analyzing the macro space to keep in mind how much liquidity is still there, right? Like you never know how much the RRP could increase by and then serve as a tailwind into risk assets, right? And moving forward, right, to what Leo said, the other side of the coin, this is the repo operations. So in a way, this is a mirror image. It's the complete opposite flow. When you have the repo, the Fed themselves, they give out cash to banks and dealers in exchange for the securities they take as collateral. So if the reverse repo is institutions basically saying, hey, I have too much cash, Fed, why don't you hold it for me? The repo, the other side of this, is institutions saying, I need cash urgently, Fed, please lend this to me. Now, in a healthy system, the repo usage should be near zero, right? There's no credit risk there. And bank and dealers can usually get short-term funding quite easily in the private market. So they don't necessarily need to rely on the Fed in terms of repo usage. But when repo spikes, and when you start seeing this chart suddenly shoot up, it means that something is wrong. It means either the funding market is stressed or institutions quite simply cannot get cash from the private markets. And we saw this before. In September 2019, the repo rates spiked to 10% overnight, and the Fed had to intervene with emergency operations. And this was like the early warning sign that the plumbing was breaking. And then again, in March 2020, when COVID hit, everything froze, repo usage exploded as the Fed, flooded the system with cash to these banks and lenders, right? And actually, if you look at recent data, we're seeing repo usage tick up again. It's not at crisis levels, but it is still elevated, and it's something we think everyone should keep an eye out. And then this brings us to the third component of the liquidity layer. So again, just to clarify, the reverse repo is high and it's draining. That means liquidity is entering the market, and this is a tailwind for risk assets. Now, when the reverse repo is near zero, which is more recently, the tailwind is exhausted, and anyone analyzing the space should be cautious. When the repo is near zero, that's good. The system is healthy, the funding markets are functioning, there's enough, liquidity and credit being supplied by the private markets. But when the repo is spiking, the stress signals, this is a huge stress signal that something is breaking. So you want to track both, and they are somewhat inversely correlated, right? So again, the RRP, it tells you about the abundance. Is there cash looking for a home, excess cash? Whereas the repo tells you about stress. Are institutions, scrambling for funding? Now together, this should give you an idea of how the Fed engages in liquidity plumbing.
Yeah, absolutely. And now we come into the second or even like third indicator, however you want to see it. If you want to see like reverse and repo as one, we come into the second one, which is the Treasury General Account, short TGA. One can think of the TGA as sort of like the government's checking account at the Federal Reserve. It essentially means when the TGA fills, that Treasury is issuing new debt and pulling cash in. And that means the liquidity leaves the system in a sense. When the TGA drains, it means the exact opposite, which is the government is spending money, and that will inject liquidity and also money into the system back again. It is also like a very direct mechanical liquidity layer. So it's not only about sentiment or expectations, it's more about like actual plumbing, as we've been seeing the last couple of months and years as well. And I also think this is where it gets even more interesting in terms of debt ceiling dynamics, because when the ceiling is hit, Treasury can't really issue new debt anymore. So they have to spend down the TGA. And that injects liquidity again into the system, which is also why markets rally often during debt ceiling crisis, which is like you wouldn't really think about it that way, even though the headlines are screaming about default risk and stuff like that. And then when debt ceiling is raised, Treasury just rushes to rebuild the TGA by issuing new, like more massive amounts of debt. And this drains liquidity aggressively after a certain while, which is also why markets often struggle after debt ceiling resolutions, even though the crisis should be supposedly over at that time. And I think understanding that and understanding the mechanics behind it will let you trade against the headline rather than with them, in a sense. And as Ayush already mentioned, if you combine the reverse repo, the repo, and the TGA together, you can sort of like explain about 80% of all the non-QE liquidity dynamics that are built into the system. And these indicators alone will tell you more about market direction than almost everything else in the space. Yet nobody or not like many are tracking it in crypto so far. And that will lead us to the third indicator, which is dollar swap lines.
The third one, yes. And again, I wanted to reiterate upon what Philip said, guys. Don't also be afraid to rewatch this, go look at other YouTubers, get through some research, because these indicators, also what Philip has, really tell a lot about where markets are going. So it's really relevant for you guys to know and to have them in your arsenal. And of course, you'll be following us, so stay tuned for more. But yeah, let's just continue with the dollar swap lines and with the other indicators.
Yeah, Leo, sorry, just one quick second. Another thing just to add here is that the easiest way, to integrate these indicators into analysis is just open up TradingView, have the Bitcoin chart, and just overlay these indicators individually and just see how Bitcoin reacts, in proportion to these spikes or drainage events. That's it. Sorry, go for it. Yeah.
There's pretty much like always a correlation or inverse correlation to any of those indicators and events. And that's like probably one of the most important lessons you can take from today, I reckon.
Exactly. Yeah, thanks for that. So, well, also my own heads up, I would say. Yeah, let's continue with the dollar swap lines, which quite differs from the other indicators. So where the other indicators could be analyzed from a week-to-week basis or a month-to-month basis, the dollar swap lines are kind of an emergency lending facility where the Fed provides dollars to foreign central banks. They only activate during, well, what I mentioned before, existential moments like 2008, March 2020, could also be 2023 during the banking stress that we had. And when foreign central banks need emergency dollars from the Fed, we actually know that the system is currently under enormous stress. So again, dollar system, dollar swap lines. What does it do? It's not a week-to-week or month-to-month basis indicator. It really is an emergency indicator. And where does that bring us? So in normal times, these swap usages are near zero. And foreign institutions get dollar easily during normal times through, well, regular market operations, like, well, other lending facilities, I would say. You could think about a ton. But during times of crises, when trust, well, actually evaporates and counterparties won't lend to each other, they need funding because dollar funding markets freeze. So the foreign banks needs to go somewhere. And well, why? Because they need to roll over their dollar liabilities, right? So they're forced to sell assets to raise dollars otherwise. So this would create a cascade in liquidations across, well, every market. And well, here's a pattern for, I would say, crypto investors who are like, okay, what does this have to do with me? So when the swap line activates, crypto crashes first because, well, it's the most risk-on asset that there is. But then when that occurs, the Fed actually floods the system with liquidity to stabilize everything. And after that fact, you can see that crypto, well, not necessarily explodes, but increases in price exponentially. And well, once this occurs, so once dollar swap lines activate, it kind of is your buy signal, and a very good one and a very strong one. There are not a lot of iterations that they occur. So, well, you can see there, you can only see 3 potential iterations in this sample period, which you can see in the graph. But it is a buy signal. And every time this occurs in a time span of 3 months, 6 months, and a year, it would have been a good trade to enter a long position. Yeah, basically that.
Yeah, thanks for that, Leo. And I think it's worth just summarizing the whole, layer 1 liquidity, just for anyone watching. So again, this is the reverse repo, right? It tells us how much sterilized liquidity is returning to the market. Now, on the other side of the coin, the repo itself, it shows us basically, is there a funding stress that's building in the background? Then we have the TGA, the Treasury, general account. And this tells us whether government spending is adding or is it draining liquidity from the market. And finally, just like what Leo went over, dollar swap lines is essentially telling us either we're in a crisis territory or not. It's very rare. And Philip likes to call it the buy signal of the decade, right? Whenever there's a huge systemic crisis happening that you can infer from the dollar swap lines?
Yes, absolutely. And I think that like covers like the whole first layer we want to like go through. And now we're on to the second one, which is the policy path. And this is essentially where we want to figure out where the Fed is going before they announce it, in a sense. This layer has 3 indicators. The first one is the 10-year TIPS yield, which actually means real interest rates. Second one is the famous initial jobless claims, which just also came out this week again at Thursday. And the third one is also the infamous global empty money supply, which is covered all the time on Twitter or like elsewhere. And I think it's very important to track that as well. But first up, we got the 10-year TIP yield, which is also known as the real interest rates. And this might be one of the single most important variables for Bitcoin from my perspective, because the reason is it is so important is because Bitcoin is an asset with zero cash flow. It pays no yields, it produces no earnings, and that essentially means the value is extremely sensitive to the cost of holding non-yielding assets. So what that means is when real rates are negative, meaning inflation is higher than nominal rates, holding Bitcoin costs you nothing. Actually, holding cash costs you something. In that environment, Bitcoin presents like probably the best risk to reward ratio. Also, the value is probably exploding in those times. But when we have like the other coin side, which is real rates are positive or spiking positive, like they did in 2022, the opportunity cost of holding Bitcoin or like non-producing assets is becoming massive. And I think that's very important because at that time, Bitcoin, for example, also collapsed. And this is probably the single variable that explains over 70% of all Bitcoin market-driven moves in the last couple of years. So what does that mean is when TIPS or TIP yields are negative or falling, it means it's a very bullish scenario for Bitcoin and non-yielding assets. And on the other side, if TIP yields are rising sharply or sort of in positive territory, it means one should stay very defensively or also not too bullish in that end. And if you map it down to every major Bitcoin move, it is most of the times very connected to the real rate dynamics, which is, for example, take 20 to 2021. It was a bull run where real rates were deeply negative. Then you had the 2022 crash, which was at that time real rates spiked from -1% to 2.5%. And now we got the recovery phase back in 2023 to 2024, where real rates kind of stabilized again and began declining from the peaks of 2.5% at that time.
Yeah, thanks for that. And I think just to like summarize the slide, it's basically Bitcoin being a debasement hedge, right? Like to its core, gold, Bitcoin, all these, these assets will tend to perform better when the opportunity cost of holding them is, a lot lower than what the market is getting from 10-year yields, right?
And I even like just to throw it in there, I think you even like told us or showed us something that Bitcoin is a better hedge than gold was over the last 10 or 15 years, wasn't it?
Yeah, that's for the next video that will drop, which is a better investment, Bitcoin or gold. And yeah, just going down this layer, right, the policy path. The second indicator we have is the initial jobless claims. Very fun indicator, to trade sometimes, but it is the highest frequency labor market, data available. And yeah, it's mainly weekly versus monthly payrolls. And this is why it matters, because the Fed in itself, its entire policy path, one of its mandate is employment, right? They can tolerate a lot of leeway in employment, but not a collapsing labor market. So whenever you tend to see the 4-week moving average of initial claims break above, let's say 250,000, it starts trending higher. This is your signal that a dovish pivot is coming from the Fed. What this basically means is that the Fed is going to cut because they have to, as it's part of one of their mandates. And here's the edge in crypto specifically, because crypto, in a way, front runs a lot of these Fed cuts by 3 to 6 months. So by the time the Fed actually announces the cut, the move has already happened, right? And the claims tell you when the pivot starts. So the key thresholds here are, if it's below 250K and it's stable, the labor market is healthy and the Fed stays hawkish. If it's above 250K and trending higher, deterioration starts beginning and the pivot starts becoming increasingly likely. And anything above 300K and accelerating is pretty much a guarantee that the Fed will cut. It's a matter of when, not if.
Yeah. And to iterate upon that as well, simply look at it from standard deviation perspective, right? So you've got your 250K. Well, you immediately know that if it's a 3 to 4 standard deviation move going to 750, 1 million, it's time to pay attention, especially the Fed pivots potentially. On the short term, most of the time, these moves didn't lead to price appreciation in the short term. So I think about a couple of weeks. But after that, in a multi-month time period, you almost always see either a correction upwards in markets, but most of the time a continuous upwards move in markets because, well, the Fed has to put in liquidity in multiple kinds of ways. So yeah, let's get to the M2 supply. Actually, one of my favorites, and now not anymore because everyone is using. M2, I think, is one of the most common indicators. It's a broad measure of money supply spread across U.S. markets, Chinese markets, European markets, etc. And we look at M2 from a growth perspective. So not as in an absolute supply, but more as in growth. So we see that when M2 is growing, more money is chasing assets. And when M2 is in contraction, so when it is in a negative growth, it means less money is chasing assets. And what do I mean with that? So imagine Bitcoin has right now an 85, 86% correlation. Well, it could deviate, but okay, with global M2. And that has right now a 6 to 9 month lag. So when M2 accelerates, price appreciation follows almost mathematically. So what do we mean with that? Is that it occurs on a more than regular basis. And crypto YouTube and crypto Twitter, they most of the time right now use it as a narrative tool. So why is crypto going up or why is crypto going down related to macro? And the global M2 pertains a very holistic view because, more money printing for a fixed supply asset, do the math, price go up. But okay, to give you a layer 2 summary. So if you've got the TIPS yield, which tells you the true cost of holding Bitcoin, initial job claims, which tells you when the Fed is pivoting or actually when a pivot is coming, and global M2, which tells you more or less where money is entering the system, or whether money is entering the system. And really important to keep clarifying, it's about the growth, not necessarily about the absolute supply. And you can see that when growth is actually higher, so when you've got a steeper slope, that there is a more aggressive response in risky assets. Okay, so these are all of our forward-looking indicators. Again, these indicators tell you where policy is going and not necessarily where it is or where it has been, which is rather important. And I think, we're already ready for the third layer right now, which is risk appetite.
So now we come into the third layer, which is the risk appetite layer. This layer is about sentiment, essentially. It doesn't mean the Twitter sentiment that we all know. It is more so about the institutional capital sentiment. And we divided that into 2 more indicators again. which essentially tell you whether big money wants risk or more on the safety side. We divided them into the equity risk premium, and the second one is the high yield credit spreads. First off, we got the equity risk premium, which from my perspective is one of the most criminally underrated ones in the space. To get to the ERP, you essentially take the S&P 500 earnings yield, that's the inverse of the PE ratio, and subtract the 10-year treasury yield. The result is the spread that tells you how much extra return stocks are offering versus the risk-free bonds, if you want to call them risk-free. When that spread is healthy, let's say 3 to 4%, stocks are compensating you for taking on additional risk. But when that goes negative, stocks are essentially offering you less than bonds, which essentially is not very beneficial for you, obviously. Then yeah, think about that. You're taking equity risk and getting paid less than you would just by holding treasuries, essentially. When that happens, it means that capital is becoming sort of homeless. It has to go somewhere in the end. And it is always searching for alternatives at that point. This explains also why institutional money rotates into digital assets when the traditional 60-40 portfolios break. And it's so much about the ideology, it's more about just math, because the returns need to be done somewhere in the end. And if you look at the US households as of right now, they hold about 63%, I think it was, of the financial assets in equities. And this is, I think, by far the highest level in history ever. It is even surpassing the .com peak. And I found a Twitter post, which we are going to be adding in here, where you can see as I said, as I've been mentioning, the 63% as of right now, which is insane. And if you then take that equity risk premium is near zero or even like negative now, it is just like a crazy scenario. The capital is massively overexposed to an asset class that isn't really compensating them for taking the risk anymore. And this is essentially meaning the setup is already built in for rotation.
I completely agree with that, right? And even just that 63% of households holding financial assets, in equities, that rotation will come with more market maturation of our asset class, which has been, the past 5 to 10 years, relatively speaking. Now, just to go on to another indicator of the, the risk appetite per se, we have the high yield credit spreads. So in a way, it's like the market's truth serum for risk appetite. High yield spreads basically measure the extra yield investors demand for holding a risky corporate bond versus treasuries. So if the spread is, let's say, 300 basis points below, it's kind of complacency. It's a very risk-on flow. Everyone is trying to go for the yield. But if the spread is above 500 basis points, it shows credit stress. It shows forced deleveraging and risk off. And the key insight here for crypto is that crypto in itself is the highest beta expression for credit conditions. When that spread starts widening, crypto often leads by 2 to 4 weeks. And you tend to get also an early exit signal before the real pain hits the market. And this indicator in itself is considered a very good defensive indicator. So once you start seeing the spreads blowing out, you need to start reducing risk. You don't wait for the price to confirm. And again, just to clarify, layer 3, you have what Philip talked about, which is the equity risk premium. It tells you when traditional assets stop paying you for taking on that extra risk by holding equities. And what high yield spreads tell you is when credit stress is building in the background. And again, quite defensive indicators, right, Philip? What would you say?
Absolutely, yeah. As we've been mentioning, I think those ones are very, very interesting in terms of getting to know the risk appetite and whether capital wants safety or risk in the end, which is essentially very, very important for the general investor from my perspective. And but let's follow through with the third the fourth and last layer, which is the global regime layer. We again divided them into two different ones. I think one thing that is very important to say here is these indicators don't change like on a weekly basis. They are more long-term cycle indicators, but when they shift, it is highly crucial and it's very important to follow it. We divided them into, first off, the China credit impulse, and the second one is the Japan 10-year minus the 30-year bond spread. But let's start with the first one, the China credit impulse. It is also called the total social financing. But why does that matter? China creates about 30 to 40% of the global credit, despite being only, I think, 18% of the global GDP. So they are marginal creator of credit for the entire world. And the credit impulse, the change of, or rather the rate of change in that credit creation, leads to grow risk assets by about 6 to 9 months in most of the times. When China accelerates credit, commodities rally, crypto rallies, and also risk assets rally, often before Western markets even notice what happens. And this can be sort of like your edge on that end. But it's also one of the most reliable forward-looking indicators for the entire asset class. You can check it on a monthly basis, but when it turns up, you have to pay attention towards it. And that will lead us to the last indicator for today, which is the...
Yeah, and just to add one point about it, I would say that, historically, right, China's credit impulse has significantly, determined the amount of injection of liquidity into crypto.
Mhm.
But moving forward, I would, there's more debate about how China is, through its own regulations, dampening the amount where that liquidity can be spread, right? Like I'm talking from just a Chinese household point of view. For example, they put recent constraints about being able to sell the gold, right? Even like its historical precedent it has with Bitcoin, because I believe that China is, has an unfavorable view to Bitcoin purely because Bitcoin, in a way, insinuates more volume with stablecoins, which is net benefit for the U.S. Treasury market, right? But yeah, it's just important to keep that in mind. Just because credit, Chinese credit credit is increasing, it does also then depend on what is the regime's take on crypto.
Fair.
Right.
And I think like China was by far the country that banned Bitcoin mining the most. I think they banned crypto for
Absolutely.
I don't know how many times already. So I think that, as you said, I think their stance on crypto and on the whole space is very, very dependent also.
Exactly. Mm-hmm. And finally, just to add on to what you said, Philip, we have the Japan, right? We have the Japanese 10 years to 30 years, the spread, right, between the
Exactly.
10 year and 30 year. So, of course, the episode Philip recorded with Leo, you already know why Japan matters. And if you don't, we really highly recommend you watch that video because they both give a pretty good deep dive on it. But yeah, this is a specific indicator to watch because Japan funds somewhere between $3 to $5 trillion in global carry trades, right? What is a carry trade? Is basically you borrowing the yen at a very cheap price and investing in higher yielding assets globally. And that carry, that sort of arbitrage, is it fair for me to say arbitrage?
Yeah, I'd say so. Yeah, it's like currency arbitrage in the end. Sort of. So
fair enough. Yeah, exactly. And that, right, that's important to keep an eye on. When the Bank of Japan loses control of the long end of its yield curve, which is basically when the 10 to 30 year spread blows out, that's when the yen carry trade unwinds violently. And I don't know if you have anything to add, Philip, just based off that last video you recorded, maybe any points about recently.
As we were mentioning, I think like from my end, there is no way on earth that the carry trade will ever stop. That's just like my personal opinion. I think Japan is trapped into that system. I think they they slowly but surely try to always navigate their way through it. But they, as I said, I think they're trapped in the system by their own design. And I find it funny that so many people are always like, yeah, carry trade is going to unwind finally now. I think it's
I mean, it does unwind, right? Like, for example, in August 2024, Bitcoin kind of crashed 30%,
absolutely
right? And it was, I guess, a localized. So, if I'm not wrong, what you're saying is that localized, short-term time frame unwinds can happen, but not fully.
absolutely
Is that what you're saying?
absolutely what I'm trying to say. I think as I said, like you can have short-term crashes, if you want to call it that way, but the overall design is not gonna change much from my perspective. I think Japan doesn't even have the leverage to really follow through what they are sort of saying right now. So I do believe that short term there might be further crashes, absolutely, which probably is also based upon Japan, but the overall theme is not gonna end. I think it will always be the leverage that big global players, big firms will use to utilize
Yeah.
P500 even more as a sort of like a
And it makes sense, right? Like, just to build on what you said, I think then the most actionable point from the slide for our listeners is that, I don't know, if you're DCAing in, right, and you see the spreads widen, maybe that's when you start having cash on hand, get ready to enter the lower cost basis, right?
Absolutely. I think it's just as we were mentioning, I think it's just important to get to know those indicators and really follow them through, also in your mind, to build up your own sort of investment strategy. But I think if you see stuff like that happening as the carry trades unwinding, if you want to call it like that, you should be prepared to even allocate more money from my perspective, because strategy will not change much from my perspective.
Not financial advice, but agreed. So yeah, just to summarize this, so yeah, Philip, you would say that China and Japan are the two major regimes that any crypto investor needs to take into account, right?
Yeah, absolutely. From my perspective, it is very important to follow them as well. Even like as important it is to stay on the sentiment of what the US is doing, and also where the miners are reallocating to other countries and stuff like that. I do still believe it's very important to also follow the Asian markets.
Understood. Would you mind just then sort of giving our viewers that complete, just a conclusion, just running them through the framework one more time?
Yeah, of course. So yeah, we have bringing it all together. If you want to like call it like that, we have those 10 indicators organized into 4 layers. Each of them is measuring a different transmission mechanism. Together, they explain why liquidity flows, where it goes, and also what it does to risk assets in the end. One very important thing is, I think you don't have to obsess over them all day, every day. I think layer 1 and 3, if you check that out like on a weekly basis, it is very beneficial towards you. Layer 2, check when Fed meetings happen, approach or stuff like that, data drops. And even like layer 4, as we've been mentioning, global regime layer, check that on a monthly basis, because it doesn't really make sense other than that. And I think that will set you up very good for your overall investment strategy, because if you follow all of those things in those frequencies, you will have a better understanding of what is happening in the market than I'd say like 90% of the people who are investing in it. And that will also give you an edge, and then like additional leverage for your own investment strategy.
Yeah, you're absolutely right. And I think, it's very interesting that macro plays such a huge part in our industry, which is good because, we're forced to keep up to date with everything.
Absolutely.
But yeah, like this framework is good enough for you to have it's very easy to make, again, a trading view chart, like a trading view, have that ready, make all these indicators there, have a composite of certain lines, right? Find where your points of pain or points of concern, and just let this composite indicator tell you, okay, do we have a constructive backdrop, or B, a disruptive backdrop?
Absolutely. Absolutely. I think it's
And that's
I
it,
think
right?
I think it's just about heads and tailwinds in the end. So whether in which direction are we heading, and what time are we facing? And I think if you can sort of understand that, you will be good to go.
Mm-hmm. Completely agree. And I think one thing that Philip has actually taught me was that whenever there's been a huge move in the market, right, which cannot be explained by fundamentals, the first thing he does is he goes through all these indicators with us. And that's when we figure out, it was because of X or Y or Z. It was because of maybe the liquidity layer or the global regime layer.
100%.
Right?
And sometimes it's even like a combination out of 2 or 3 of them.
A few of them.
Simultaneously.
Yeah.
I think that's where like the actual work comes in then, because everyone check like those indicators. But if you can compare them and also stress test them against each other, I think that's where the edge actually comes from. But everyone can do it in the end.
Exactly. And then just on that note, if you're still listening and you're still here, and if you would like to get access, to that macro composite indicator that we have built in-house and back tested,
Absolutely.
drop a comment and we'll think about it. We'll think about it. No, it's okay. And yeah, that's it, right?
That's it.
That's it. All right. Thanks a lot. Tune in, like and subscribe, donate.